of course, remember, is expiry day. Yesterday, we did pretty okay, managed to hold on to that 22,450 print, in fact, on the Nifty futures for the better part of yesterday's trading session. And then from there, gave up our gains to close in absolutely quiet. Of course, there were metals, there were a lot of individual stocks which did support the market. But here's a look at the global setup this morning. It's been a mixed close for Wall Street. You've got a lot of earnings coming in. You've got Meta, IBM, both delivering their numbers. Meta has seen a double-digit crack for itself. But US futures also, because of that, are taking a drubbing as we speak right now. A bit of a rise coming in for the yield as well. The 10-year is now topping that 4.65% mark. And yes, investors are awaiting that all-important economic print of the Q1 GDP as well.
Yeah, it's a okay kind of a setup. Nothing good, nothing great, nothing bad, nothing ugly. What matters first thing every morning is that has anything happened on the geopolitical front? Nothing has happened there. Depending on the kind of numbers which are there in terms of, because we have our earnings season in India, US is going through the earnings season, you are seeing reaction. And that I think was evident in the way how benchmark indices or US indices last night closed. Asian handover not the best. So global cues are not going to be impacting the trade sentiment per se. It's going to be a minor nick, and that's about it. So I would say global cues are stable. The bias is mildly negative, but more importantly, there is no new narrative on geopolitics. There is no development on that front, thankfully. There is nothing which has come on a macro front, and there is nothing in terms of a new news development which really could change the setting on the table. So I would say status quo for global market. US GDP data very important, very crucial, given that market right now are confused about which way inflation and trade dynamics would move. So US GDP data in a sense could really have a near-term impact in the way how the global setup would move. But frankly, for me, the global setup today is more like a no starter. You cannot derive too many cues from it.
Okay, yes, indeed. Perhaps the fact that there isn't any development on the geopolitical front that's adverse is going to be taken quite hearteningly by the street. But yes, as Aisha was flagging off, our run-up continued in yesterday's trade. It was not just the frontliners. The mid-cap index hit a one-week high. The small-cap index was also at a record high. And it was an outperformance within the broader universe. So 4 sessions streak that we have seen the run-up continue. That's ahead of the expiry. And the print on the frontline index as well was encouraging. Most of your sectors did manage to gain, but it was rate sensitives that were at the forefront, be it metals or even the real estate pack that gained for a third straight day on the chart. So clearly a lot of support coming in within the broader universe and the rate sensitives, Nikunj.
Let me try and connect the dots here, and I'll take the market back to Jan and Feb. It was all about this runaway rise, and the party continued in small and mid-cap stocks. March, we saw what was this mid-air turbulence and a brutal sell-off in mid and small cap stocks, which shook the belief in mid and small cap stocks. Everyone thought the party was over. Then came the migration from small cap to mid cap and large caps. They suddenly started outperforming. But now one is getting a sense that while large cap stocks may not continue to go up in a hurry, small and mid cap stocks, that whole March sell-off trade is clearly behind us. And that explains that why purely from a positioning standpoint in the near term, it appears that the small and mid cap stocks do have potential to continue to outperform, at least in the run-up to the election. The market can be looked at. What is the most important moving part for the market? The positioning ahead of elections. And given that volatility has got crushed India VIX, it means there is no nervousness in the market. The general belief in the market is that FIs will continue to sell, and which they are selling. That is capping the upside for large cap stocks. But because globally everything in terms of a news has got, there's nothing scary in terms of a news development, the confidence to revisit small and mid cap stocks, I think, is evidently coming back, which is also getting supported by local money. Thankfully, we've not seen any large IPOs of late. There are no large block deals which have happened. Vodafone FPO was a success, which will make markets very happy about small and mid cap stocks. And the excitement to revisit mid and small cap stocks ahead of the election, I think, is there. So this is like a typical time when you would say that you need to be a bit watchful, but you need to understand that the sentiment and perhaps the mood of the market is once again favoring small and mid cap stocks.
Absolutely, and in the thick of earnings, you've got a whole host of them to react to. Axis Bank, of course, has been a decent set. The higher credit costs have managed to offset the fee income for them. There have been treasury gains, and brokerages are liking it. Macquarie is continuing to maintain its outperform with a target price of 1,300 on Axis. I mean, to be fair, after what we've seen from HDFC Bank, or for that matter, on the news flow on Kotak Bank, Axis definitely is quite the relief. They've seen strong granular deposit growth as well, which has been encouraging. The PAT has been a beat. Higher fee income, treasury gains, NIMs have partly offset by higher credit costs. Of course, brokerages believe that now you got to focus on the LDR, which is going to remain under pressure, and NIMs, which are going to drive the profitability from here onwards. For Unilever, the volumes have been flat, although they're talking about an improved demand outlook, and in some of the key product categories, they are seeing a revival in terms of the rural demand as well. For LTI Mindtree, though, the management says very categorically that they're going to return to growth in the first quarter of FY25 itself. But let's start off with Axis. I think that's the most positive one.
Yeah, on all quarters, it's been a good quarter. Growth, NPAs, their liability franchise, how CASA ratios are moving. So I think for Axis Bank, one thing is clearly evident, that the turn which everybody thought that was more like, the turn which everybody doubted when it initially started, they managed to keep their momentum going, which is what is important. So in the large cap banking space, it's really about the pecking order, where there is visibility for next 2 or 3 quarters or 4 to 5 quarters. On that front, I think Axis is giving you decent amount of visibility. We'll discuss Kotak, but Kotak is going to suffer because of the news. HDFC Bank, growth is not there. IndusInd Bank is trying to make a comeback, and then SBI in a sense is now occupying leadership position. Within that, Axis now is at a very interesting part. So the pecking order now in the large cap banking space really could be ICICI Bank, then it is somewhere Axis Bank, then HDFC Bank, then IndusInd Bank, then Kotak, in terms of how things would move. 3 years ago, we would have set a completely different pecking order. So these numbers in last couple of quarters, what Axis has done is that it has really been on the right side of brokerage upgrades. It's not a very expensive stock. And again, on a relative and an absolute basis, I think these numbers will ensure that Axis Bank's positioning in terms of the pecking order moves a rank higher.
Okay, and speaking of banks, the one bank that had everyone talking yesterday, lots of groups as well, a buzz, was a Kotak Bank. And it was a very tough disciplinary action that came about by the Reserve Bank. They barred Kotak Mahindra Bank from issuing fresh credit cards, barred them from onboarding new customers via online or banking channels, and they have cited serious deficiencies in their IT system and repeated failures to fix them. We will be discussing this in greater detail, but Nikunj, a very tough disciplinary action and a setback for Kotak Bank.
It's actually shocking that why Reserve Bank of India had to take these such a strong stand against Kotak, and RBI has pointed out to serious deficiencies and non-compliance despite repeated red flags which were being raised. Now, what does that mean? That means that Kotak, which again has been a complete world-class bank in terms of technology, adaptation, customer satisfaction, they have failed to really comply with the basic framework, which is the benchmark requirement of Reserve Bank of India. Now, this is about the customer experience and what is happening on the digital space. Kotak's digital engine has been the high growth engine for them, both in terms of credit card and also new customer acquisition. Kotak has been growing their non-unsecured loan book at a rate which is higher than their normal book. And now, and large part of the acquisition actually was coming through this entire franchise, which is the digital franchise. They'd already gone on record and they said that this unsecured book, which was 10 to 11%, will inch higher towards 14-15%. That was given this growth to Kotak. What will happen because of this is that that growth in a sense will now be stalled. As a result, for FY24 and FY25 and FY26, the earning estimates will come down. Now, more than the actual damage, I think in the near term, I think it is really the sentiment which really could be a big drag for Kotak. Now, a similar kind of an incident happened with HDFC Bank when Reserve Bank of India had raised concerns on the credit card business and some technical deficiencies, imbalances. It took them about a year before they got the permission, because once Reserve Bank of India really bars you from doing something, it's not going to be tomorrow morning you will get the permission. So it's going to be lock off back and forth which will happen. They have to convince the regulator that the concerns which you've raised, we've addressed it, and in future also these things will not happen. Which means that 12 se 15 mahina, nothing. Which will have an impact on their growth. It's not going to be a large impact. 1 to 2%, that's what brokerage is saying. But more than that, the sentiment impact would be there. And as it is, Kotak Mahindra Bank, because of the CEO change, markets are trying to think, okay, what will be the equation, how things would move. It has been an underperforming stock. In an underperforming stock, when things were just getting ready, I think when such news comes, the underperforming stock will become seriously underperforming stock. Yeah. But I'm surprised that for a bank which in a sense always took a lot of pride in their digital capabilities. Yeah. I mean, their digital capabilities are far superior than a lot of other banks, 811 and other things, the whole branch and the whole way they were able to do the retail work. Why did they overlook it? And why did they overlook it again and again?
Yeah, in fact.
If you like this video, then like, share and subscribe to ET Now.